Net income for South Plains Financial Q2 2026 printed at $19.0 million. That is a pretty sharp step up from the $14.5 million we saw in Q1. Diluted EPS came in at 96 cents, so beating Q1's 85 cents. Net interest margin did compress slightly, down to 4.0 flat.
Right, but I mean, the structural headline here, the thing you really have to look at, is the balance sheet. Loans held for investment just surged to $3.77 billion, and total deposits reached $4.64 billion.
Yeah, and beneath those headline numbers, you've got this story of a bank basically trying to swallow a massive acquisition whole.
Right.
And doing it right in the middle of a brutal Texas rate war.
Exactly, which is why we're breaking down SPFI's Q2 2026 print for you today in this deep dive. You know, as a retail investor, you have to look strictly past those raw top-line figures.
Right, we're looking at segment performance, margin dynamics.
Yeah, management commentary, the macro risks on the horizon. Because to model this stock correctly, I mean, you really have to understand how a regional bank digests over $600 million in new assets in real time.
So if you're looking at that headline loan and deposit growth, you have to immediately identify the catalyst. You can't just, plug those growth rates into your forward projections.
No, definitely not, because this wasn't organic.
Right. On April 1st, 2026, SPFI officially completed the acquisition of BOH Holdings and its subsidiary, Bank of Houston.
Exactly. April 1st is the line in the sand for this balance sheet. I mean, they acquired approximately $667 million of interest-earning assets in a single stroke.
Wow.
Yeah, to break that down, that is $631.9 million in loans and $595.6 million in deposits instantly injected into their system. It just it changed the math on everything from their capital ratios to their margin pressures on literally day one of the quarter.
Bolting the Bank of Houston onto their balance sheet, it's really like an organ transplant while the patient is running a marathon.
That's a great way to put it.
Right, because you get a stronger heart, you get immediate power, immediate scale, but your body has to spend this massive amount of energy just to make sure the tissue isn't rejected. All while you're, still trying to run the race at full speed.
It is the perfect way to look at it, honestly, because it completely recontextualizes the organic numbers. Like, when you isolate the pure organic loan growth for the quarter outside of the acquisition, it was only $35.4 million.
Right, and that $35.4 million is net of two specific, fairly large loan payoffs that totaled $37.5 million.
Precisely. So when you look at the raw expansion of this bank, the BOH acquisition was the undisputed heavyweight driver of Q2's scale.
No question.
Total loans held for investment now sit at $3.77 billion.
Yeah.
And that composition is heavily weighted toward commercial paper.
Yeah, let's talk about that, because looking at that $3.77 billion loan book, it is heavily skewed toward commercial real estate. That is a $1.33 billion exposure. And in a high-rate environment, that usually sets off alarm bells for investors. Why are they leaning so heavily into CRE alongside, $827 million in general commercial and $429 million in specialized commercial?
Well, is the engine because they're operating in Texas. Texas is a massive, highly capital-intensive market. But when you take on that much commercial exposure, especially through an acquisition, you really have to track how this M&A activity altered the equity structure.
Right.
So book value per share jumped from $30.90 at the end of Q1 to $33.43 at the end of Q2.
And if you're an investor, you see book value jump and you instantly want to know the mechanics, right? Like, how did they actually drive that?
You look at the mechanics of the deal itself. SPFI issued 2.8 million shares for the BOH acquisition, and they did it at $41.90 a share.
Okay, so a premium.
Exactly. When a bank issues equity at a premium to its existing book value, it is highly accretive. You are mathematically pulling that overall book value up.
Right, that makes sense.
That premium issuance, combined with $15.7 million of net income retained after dividends were paid during the quarter, that's what drove that top-line equity expansion.
But wait, if you're modeling the actual intrinsic value of the bank, you don't just look at headline book value, you look at tangible book value.
Absolutely.
And if we strip out the $67 million in goodwill and the intangible assets generated by the BOH acquisition, the tangible book value actually stayed essentially flat. I mean, it moved from $29.65 down just slightly to $29.57.
And that is a critical distinction for retail investors to make. Goodwill is just an accounting premium, right? It's the amount they paid over the fair value of BOH's net assets.
It doesn't represent hard cash or liquid assets.
Exactly. So when you strip that out, the fact that tangible book value remained relatively flat is actually a massive victory for them. The ratio of tangible common equity to tangible assets held incredibly steady at 10.47%.
So while the headline book value surged, the actual tangible equity profile, like the hard structural safety net of the bank, remained highly stable through integration. They didn't dilute the quality of their capital to buy that scale.
They didn't. Which brings us directly to the income statement.
Yeah.
We've established the size of this newly transplanted organ. Now we have to look at the caloric burn.
Right. How does this new scale translate into actual revenue and margin?
Exactly.
Well, for the first 6 months of 2026, total revenue was $118.6 million. The split is 79% net interest income, which is the core business of lending, to 21% non-interest income. Let's look at the lending side first.
Okay.
Net interest income hit $50.3 million for the quarter. That is a solid increase from $42.9 million in Q1 and $42.5 million in Q2 of last year. Total interest income was $75 million. But the metric you always have to watch with regional banks is the margin.
Always.
The net interest margin actually slipped from 4.04% to 4.00%.
Yeah, and that 4 basis point slip, it is the classic M&A margin squeeze playing out in real time. Well, SPFI bought a tremendous amount of growth with the Bank of Houston, but they also bought higher funding costs. They brought on approximately $611 million in interest-bearing liabilities from BOH, and they had to, absorb that specific rate structure into their own ecosystem.
Wait, so they essentially bought a much bigger house, but
they inherited a massive, highly inefficient utility bill in the process.
Exactly.
Ouch.
Okay.
The cost of running that larger balance sheet went up. The average cost of their deposits rose 11 basis points quarter over quarter, hitting 208 BTBs. And management explicitly stated in the release that this increase was directly tied to the higher cost of the acquired Bank of Houston deposits.
Because in a fierce Texas deposit market, you can't just, slash the rates on those newly acquired customers, or they'll just take their money down the street.
Right, you have to eat that cost to retain the liquidity.
And the asset side didn't bail them out either, did it? I mean, you would hope the new loans they acquired were yielding enough to offset those expensive deposits, but the average yield on loans actually dipped slightly from 6.83% in Q1 to 6.81% in Q2.
Right. Let's look at the broader yield tables to see the squeeze. The total interest-earning assets yielded 5.95%. Meanwhile, total interest-bearing liabilities cost them 2.79%.
That's a tight spread.
It is. Because of that volume of new expensive liabilities, interest expense jumped $4.9 million quarter over quarter to $24.7 million. So yes, top-line net interest income is up on pure volume, but the efficiency of that margin took a slight hit.
Which means this was a calculated trade-off. Management basically accepted slight near-term margin pressure to secure a massive chunk of long-term market share in Houston.
Precisely. And when your margin gets squeezed by expensive new deposits, a well-run bank has to generate cash elsewhere to survive it. Which brings us to that remaining 21% of their revenue mix, non-interest income.
Right. Non-interest income grew to $14.1 million, up from $11.3 million in Q1. If you look at the composition for the first 6 months, mortgage is driving 34% of that, interchange fees are at 29%, and service charges on deposits make up 18%. But for Q2 specifically, there were 3 key drivers to that $14.1 million print. First, you had a $929,000 bump in mortgage banking revenues, driven by better originations. Second, an $894,000 increase in bank card services and interchange revenue, which is just healthy customer card usage and volume incentives.
But the third driver is the most important one for investors to really grasp. They recorded a $515,000 upward fair value adjustment on their mortgage servicing rights, or MSRs.
Mortgage servicing rights can be incredibly confusing for retail investors, mostly because they act completely counter to how you think about regular mortgages. Can you break down why this specific asset generated $500,000 basically out of thin air this quarter?
Sure. It comes down to the mechanics of a natural hedge. When a bank originates a mortgage, they often sell the actual loan to investors, but they retain the right to service it.
Meaning they collect the monthly payments, handle escrow, that sort of thing.
Exactly. And they take a small fee for doing so. That right to service the loan has a financial value.
Okay, so they own a stream of future cash flows.
Right. Now, what happens when interest rates stay persistently high?
Homeowners do not refinance.
Exactly. Because if you have a 3% mortgage, you aren't going to refinance into a 7% mortgage. That means the bank gets to collect those servicing fees on those existing mortgages for a much longer period of time than initially modeled.
Oh, I see.
The duration of the asset extends, Therefore, the present value of those mortgage servicing rights goes up.
So it is a built-in shock absorber for a high-rate environment. When high rates are punishing their borrowing costs on the deposit side, high rates are simultaneously making their MSR portfolio more valuable, providing a nice tailwind to the non-interest income print.
That's exactly it. Last year in Q2, rates were different, and they had to take a $156,000 write-down on that exact same line item.
Wow, okay. So it is a volatile line item, but it did its job perfectly this quarter to offset some of that NIM compression.
It did.
I understand the MSR boost, but look, if you're modeling SPFI in your spreadsheets right now, I've got to push back a little on the headline non-interest growth.
Okay, why?
Well, you see that jump from 11.3 million to 14.1 million, and you might think it is all operational momentum that you can just project forward. It is not.
I know where you're going with this.
Yeah, because in Q1, SPFI took an $801,000 loss on a small business investment company, an SBI. That loss rolled off the books in Q2. It didn't repeat.
Right.
So that favorable quarter-over-quarter growth comparison is artificially juiced by almost $1 million of non-recurring drag simply disappearing from the ledger.
And that is exactly the kind of noise you need to filter out when you are building a financial model. When you strip out that SBIC loss from the Q1 baseline, the core operational growth in non-interest income for Q2 is still solid, but it's not quite as explosive as the raw top-line delta suggests.
Right, it keeps expectations grounded. Let's move down the income statement, though, and assess the cost of doing business. Top-line revenue looks solid, but non-interest expense bumped up to $39.9 million for the quarter compared to $35.5 million in Q1.
Yeah, that's a $4.4 million increase in just 3 months.
Where is that cash going?
It breaks down into 2 distinct buckets. First, you have $1.1 million in direct, one-time acquisition-related expenses for Q2. $710,000 of that was allocated strictly to personnel expenses. Think severance packages, retention bonuses, basically the human cost of merging two corporate cultures.
Okay, so that $1.1 million should theoretically roll off in future quarters, but what about the rest?
The second bucket is a $2.7 million increase in core operating expenses. And this is the frictional cost of growth I mentioned earlier. You don't just buy a $600 million bank and run it on your old servers with your existing staff.
Right, obviously not.
You have to integrate the tech, you hire new commercial lenders to defend the newly acquired territory, and you have annual salary adjustments. Salaries and employee benefits jumped from $19.7 million in Q1 to $23.5 million this quarter. Net occupancy expense ticked up to $4.5 million.
So that $2.7 million increase is the new run rate. That is the permanent energy required to sustain the new organ transplant.
Yes, you are seeing the real-world costs of structural expansion hitting the income statement right now.
And if you're an investor, you see expenses rising by $4.4 million and you immediately look for risk on the balance sheet. If it costs more to run the bank, are they taking riskier bets to pay for it?
Right, that's the natural question.
Let's look at the health of the underlying portfolio. With $3.77 billion in loans, the asset quality metrics are what actually dictate the downside risk of this stock.
And honestly, considering they just swallowed a bank hole, the credit is surprisingly pristine. The ratio of non-performing assets to total assets is a microscopic 0.19%. Annualized net charge-offs were just 6 basis points.
That's incredibly low.
It is. But the metric that really jumps off the page to any bank analyst is the provision for credit losses. They provisioned just $350,000 for the entire quarter.
Wait, only $350,000 in reserves for a quarter where they added over $600 million in acquired loans? That seems almost suspiciously low.
Well, it is the real story of their risk management. Compare that $350,000 to the $2.5 million they provisioned a year ago in Q2 2025.
Oh, wow.
Yeah, the decrease year over year is largely because last year's Q2 included a deliberate increase in specific reserves and several credit quality downgrades. The fact that they provisioned so little this quarter means that when they audited the Bank of Houston loan book, they didn't find toxic assets.
So the underlying credit culture at both SPFI and BOH appears highly disciplined.
Exactly.
Yeah.
The allowance for credit losses to loans held for investment sits very comfortably at 1.41%.
We also need to look at how they are managing liquidity and interest rate risk off the loan book, specifically through their securities portfolio.
Right.
Investment securities totaled $555.4 million, which is actually a $47.4 million decrease from Q1. It is a very conservative, shrinking book. All securities are classified as available for sale. It breaks down to 53% mortgage-backed securities, 32% municipal bonds, and 12% collateralized mortgage obligations.
And note the geographic focus there. All of those municipal bonds are localized in Texas. And what's fascinating is how they are protecting that specific asset class. They have $117 million in fair value hedges on those munis.
Let's explain the strategy behind that hedge because it really shows how management is actively defending the balance sheet.
Yeah, so a municipal bond's value drops when the broader interest rates go up. That's just standard bond math. Because management knows they're operating in an environment where the Fed might keep rates elevated for longer than expected, they bought derivative contracts, these fair value hedges, on $117 million of those bonds.
So if rates stay high and the bonds lose paper value, the hedge pays out, neutralizing the loss. So they've insulated their capital position, and all the MBS and CMOs are U.S. government or GSE backed. The duration of the entire securities portfolio is 6.27 years. It really demonstrates a highly structured, defensive approach to managing their asset liability mix while they, deploy their real capital into digesting the BOH loan book.
It is defensive because they have to be. We have to factor in the macro headwinds here. When you read the safe harbor disclosures, management is acutely aware of the systemic risks threatening their pristine credit metrics.
Right. You have the persistent elevated interest rate environment we just talked about, sticky inflation data, and that fierce deposit competition driving up their funding costs.
Yeah.
But the big one goes back to what we highlighted at the top. Out of that $3.77 billion loan book, $1.33 billion is commercial real estate. They have intense, highly concentrated exposure to Texas real estate.
And look, Texas is a premier high-growth market, but it is not immune to gravity. If you see a broad macroeconomic decline in commercial real estate values, or a prolonged recession that hits occupancy rates in Houston or Dallas, SPFI's balance sheet is heavily exposed.
Right.
Slower economic growth rates, spikes in unemployment, or a sudden deterioration in borrower habits could rapidly change those non-performing asset numbers. The 0.19% NPA ratio looks bulletproof today, but CRE is a lagging indicator.
So who is steering the ship through this CRE risk and this massive integration? Because we've got a monumental transition happening in the C-suite right now.
Yeah, we do.
Curtis Griffith, the chairman and CEO who has been on the board since 1993, is retiring at year-end.
And this raises a vital question regarding execution risk for anyone holding this stock. Transitioning a legacy CEO while digesting your largest acquisition in years requires flawless operational discipline. I mean, Griffith essentially built the modern iteration of this bank over 4 decades.
Yeah. In his parting remarks in the earnings release, Griffith emphasized that he is leaving the bank in a position of strength, specifically pointing to the BOH integration as the final move that secured their foothold in highly attractive banking markets, specifically Houston.
And stepping up to lead the organization is President Corey Newsom. And if you read Newsom's forward-looking commentary, it was highly targeted. He isn't talking about pausing to rest.
Not at all.
He prioritized expanding their lending platform in high-growth Texas markets, specifically calling out the Permian Basin and the Dallas-Fort Worth MSA.
If we look at the underlying economics for those markets, the strategy makes perfect sense for a commercial lender. I mean, the Permian Basin is the largest oil-producing region in the United States. It spans West Texas and southeastern New Mexico, producing approximately 6.6 million barrels per day. That represents 48% of total U.S. production.
And oil production requires heavy equipment, massive payrolls, and constant cash flow management. It is a capital-intensive economic engine that is perfectly suited for a regional bank's commercial lending arm. Meanwhile, DFW is the largest MSA in Texas and the 4th largest in the nation. Newsom isn't pivoting the bank's core identity. He is directing their newly expanded capital base toward markets that just have immense demographic and economic tailwinds.
Furthermore, Newsom has spent his entire banking career with the company. He has focused on lending and operations for decades and was actually appointed president of the bank way back in 2008.
Right.
That kind of tenure suggests total continuity in SPFI's relationship-based banking model.
It is a textbook transition strategy, provided the execution matches the blueprint. And they have the foundation to support him. They now boast a $5.39 billion asset base, a consolidated total risk-based capital ratio of 16.53%, a Tier 1 leverage ratio of 12.29%, and a return on average assets of 1.44%.
Wow.
The structural capital cushion is undeniably there to support both the leadership change and the ongoing BOH digestion.
Which leaves you with a critical forward-looking question as you update your models on this stock. With the Bank of Houston successfully absorbed onto the balance sheet, the capital ratios remaining robust despite the integration costs, and Corey Newsom officially taking the helm, is this Q2 print the blueprint for a more aggressive Texas roll-up strategy? I mean, will they look for another acquisition in a year?
Or will SPFI focus purely on organic digestion and methodical market share capture in the Permian Basin and DFW? Managing a $600 million asset injection takes time, and the margin squeeze from those expensive deposits really needs to be resolved through organic repricing.
That organic loan growth versus acquired growth ratio is the exact metric to watch next quarter. Make sure you follow the show for daily earnings coverage.